Hello and welcome to Quantum Advisory's Q1 2024 Investment Vodcast. Here we will be covering a quick overview of investment markets over Q1 2024. We'll be highlighting the key economic issues concerning markets at present, discussing the performance of various asset classes including fixed income and equity markets, and then we'll be finishing off with our outlook on markets going forwards. Okay, so we'll just start off by highlighting some key issues concerning markets at the moment. So inflation continues to trend down in the UK, but it has appeared to somewhat plateau across the US and the Eurozone, as you can see by the chart on the right-hand side there. So we've seen an easing in the factors that have contributed to the recent high inflation, such as food and energy price rises due to the Ukraine war, global supply chain issues, and also strong wage growth. So February CPI came in at around 3.4% in the UK, which is down from 4% during December and January. This is primarily attributed to a slowing in food prices as well. However, in the US, CPI was reported as 3.2% in February, which is higher than what it was back in June 2023, and meanwhile Eurozone CPI, was 2.4% in March, which was the same as what it was in November, 4 months prior. So we may see a similar plateauing occur in the UK. The Bank of England expects inflation to fall to 2% momentarily in Q2 2024, but then increase again thereafter in the latter half of the year. So what does this mean for interest rates? Well, central banks have held interest rates for quite some time now, as we can see by the chart at the top right. The Bank of England have reiterated as well that they aim to meet their 2% inflation target sustainably, and as they expect inflation to fall and then rise again slightly, they may be, fairly cautious when reducing interest rates. In the UK, the first rate cuts are expected still to come in June 2024. In the US, meanwhile, the Fed are expected to cut rates to around 4.6% by the end of this year from the current level of 5.5%. In other news, in terms of growth, economic growth, so the UK fell into a recession over the latter half of 2023. So that was 2 consecutive quarters of negative gross domestic product growth. So that, the recession was quite mild, and GDP growth is expected to be positive over 2024 and 2025. The UK does, however, seem to have a wider productivity issue, as the economy has been stagnant basically now for around about 2 years. Elsewhere, another issue concerning markets and the news, I guess, at the moment, grabbing a lot of headlines, are in elections. So there are a lot of elections coming up still this year, not least in the UK and the US. So the UK general election is due to take place later on this year, although we don't know the date yet. The Labour Party has a considerable lead in current polls, and the recent recession will not have helped the Conservatives' cause there. In the US, Donald Trump has been confirmed as the Republican candidate, and the Republicans and the Democrats are neck and neck in most recent polls overall. However, it is reported now that the Republicans do lead in certain swing states as well, so maybe that will give them a slight edge on polling day. Finally, as well, geopolitical risks remain a key concern for markets at the moment. Ongoing conflicts are a primary concern for markets. As such, risks could revive supply chain issues and inflationary issues as well. We've obviously seen the Ukraine and Russia conflict have a severe impact on inflation in recent years, and also more recently the issues unfolding in the Middle East that are also a cause for concern. And these issues, have generally just highlighted the fragility of global supply chains and markets, I guess. Okay, so moving on to performance. Starting off with UK fixed income. So bond prices fell over the quarter. This came in light of stickier than expected inflation and a subsequent correction in interest rate expectations. We saw a sell-off in government bonds and corporate bonds in the UK, and this poor performance was seen across the whole curve, which can be seen by the rise in yields on the curves at the top left there. So moving from the start of the quarter in red to the end of the quarter in blue. So gilt implied inflation expectations rose over the quarter as well, as can be seen by the chart at the top right. And this marks a slight reversal in what happened over the previous quarter, where inflation expectations fell over the previous quarter. Credit spreads have remained generally stable over the quarter, actually, as can be seen on the bottom left. However, they have been falling for quite some time now, maybe over the last 18 months or so. In terms of sector returns, so we've seen, as I said, poor performance in government bonds. That's both index linked and nominal government bonds, and that's over the quarter and over the 12-month period. We've seen a sell-off in corporate bonds as well over the quarter. However, they have fared a little bit better over the 12-month period following that decrease in spreads that we've seen. And then finally, as expected, a positive return that we've seen on cash at the moment, with interest rates where they are. Okay, moving on to growth assets. So equities have once again produced positive returns over the quarter, with US and Japanese equities leading the way. It was a similar story over 12 months as well, as equities produced strong returns and the US outperformed its peers. And this can be seen in the chart on the bottom right-hand side there, with the red bars depicting the quarterly returns and the blue bars depicting the 12-monthly returns. So US equities have generally performed well, as the technology sector has outperformed the wider market. So the Magnificent Seven have performed extremely well as AI sentiment has gained a bit of traction. Nvidia, Meta, Amazon, and Microsoft have performed particularly well this year. Emerging markets have underperformed developed markets over the quarter. They've also underperformed over 12 months and 3 years, as we can see at the chart on the top left there. Some significant underperformance, for emerging markets. But this underperformance for emerging markets has been going on for a little longer than that. They've been underperforming developed markets for, since 2010 or something similar now. So volatility has decreased over the last 18 months, as we can see by the chart at the bottom left, but it has remained fairly stable over the quarter. And then finally, commodities at the top right. Gold has continued its rally due to central bank demand. Chinese and emerging markets, mainly there, purchasing to reduce their reliance on the US dollar. And also the expectations of interest rate cuts has helped gold a little bit there as well. Crude oil prices have remained fairly stable over the year, up until the end of the quarter, at least anyway, increasing slightly over Q1. And OPEC countries and their allies have implemented supply cuts when needed in order to stabilize the global oil market. Okay, so let's move on to the economic outlook. So the general message from us is the economic environment is improving, but risks still remain. In terms of inflation, inflation continues to trend down in the UK, but as mentioned, we've seen a plateau in the US and the Eurozone recently, with inflation actually increasing in the US as well. So inflation is expected to fall further in the UK over the first half of 2024, and then it is expected to increase slightly again in the latter half of the year. So in light of this, interest rate cuts are expected this year still, We'll likely see the first cuts occur during Q2 or Q3. The Bank of England obviously may be a little bit cautious considering they expect inflation to increase again slightly if it comes down further over the next few months. Geopolitical risks remain a key area, though, in terms of inflation, and recent conflicts have shown how fragile supply chains are, and further issues could arise in the future. In terms of economic growth, the UK, of course, went into a recession over the latter half of last year. However, the UK is expected to grow over the next 2 years. That said, the UK growth is expected to be quite modest relative to US projections, at least anyway. And as you can see by the chart on this slide, it shows the IMF growth forecast over 2024. All major economies are expected to grow over 2024. Okay, and finally, we'll just highlight what this means for our asset class outlook. So starting off with equities, we remain neutral on equities at the moment as geopolitical risks and sluggish growth across the developed world remain. Stock and regional selection are key, given high inflation and those geopolitical risks, favoring areas with resilient pricing and stronger supply chains. We have experienced strong performance of late as well, which has led valuations to look quite high in some areas relative to historic standards. Global indices as well have a high concentration to US technology stocks. So as mentioned earlier, the Magnificent Seven have performed quite well. They form a large part of the US stock market now. So, we could see we are seeing, some high concentration in the US and the global indices due to that anyway. In terms of bonds, we remain positive on UK government bonds and the wider credit market as yields remain quite attractive relative to historic standards. Income yields as well are quite attractive, and interest rate cuts this year could result in capital appreciation. I guess the direction of travel for inflation over the next few months will be a key factor there. In terms of UK government bonds, net supply has increased substantially over the last 2 years. Until now, this increase in supply has been met by equivalent demand from overseas investors and banks, which have become attracted by the relatively high yields. And also we've seen still quite strong demand from the core investors such as pension schemes and insurers as well. Our primary concern with UK government bonds is whether this demand will be high enough in the future if yields fall, and this could result in a negative impact on prices if that were to happen. In terms of the wider credit space, investment grade credit looks quite attractive on a risk adjusted basis as company balance sheets remain generally strong. However, higher interest rates could result in an increase in default risk there and a subsequent widening in credit spreads. And then finally, we remain positive on alternative investments as illiquidity and complexity premiums remain attractive. The switch to e-commerce as well and the transition to a low carbon economy provide some opportunities within that sector. And then likewise for many other asset classes, inflation, economic growth concerns and interest rates remain the key risks here. Okay, so that wraps up our session for today. Thank you very much for listening to our quarterly investment vodcast. We hope this edition has been quite useful for you. And if you have any questions, please do follow up with your Quantum contact. And once again, thank you very much and goodbye for now.
Thank you for listening to Quantum Advisory's quarterly investment vodcast. We hope this edition has been informative and provided you with a useful update on the current economic climate. If you would like to discuss any of the topics raised in more detail, then please get in touch with your Quantum contact. Once again, thank you and goodbye for now.